off chance. We did see inflation data coming in yesterday and it moderated a little bit in April. Now this does at least give the Reserve Bank a little more room to pause in its rate hiking cycle, because of course rate hikes are there to target inflation, basically to put a damper on spending in the economy so we don't see prices rising too quickly. So because of that inflation data, there is some scope for the Reserve Bank to pause. But then again, we also have America. Again, predictions of interest rate hikes in America. Will that influence our decision? Let's take a look now. I believe the Reserve Bank Governor, Lesetja Kganyago, ready to speak.
Temporary, as food and petrol price pressures continue to intensify. The recovery in the rand exchange rate in April also proved to be short-lived, as both domestic and external factors weighed on the currency. At the same time, domestic economic growth continues to disappoint. While there are signs that the economy may be reaching the low point in the growth cycle, the recovery is expected to be slow, with downside risks. Global economic growth and financial market conditions have stabilized somewhat since the previous MPC meeting, but a high degree of risk and uncertainty persists. The year-on-year inflation rate, as measured by the Consumer Price Index, CPI, for all urban areas has moderated after reaching a recent high of 7% in February. In March and April, CPI inflation measured 6.3% and 6.2%. Food price pressures continued unabated, with food and non-alcoholic beverages inflation accelerating to 11% in April, up from 9.5% previously. Goods price inflation moderated from 6.9% to 6.7%, while services price inflation was unchanged at 5.7%. The bank's measure of core inflation, which excludes food, fuel, and electricity, measured 5.5%, up from 6.4% in March. While the impact of weaker exchange rate remains relatively low, there are indications of increased pass-through in some categories, particularly new motor vehicles and appliances. Producer price inflation for final manufactured goods moderated significantly from 8.1% in February to 7.1% in March, mainly as a result of a sharp fall in fuel prices. Manufactured food product price inflation accelerated to 10.5%, with the category of food, beverages, and tobacco products contributing 3.1 percentage points to the March outcome. Agricultural prices increased by 23.1% in March, with cereal and other crop prices increasing by 50% per year, 50% year on year. The latest inflation forecast of the bank shows a moderate near-term deterioration compared with the previous forecast, but there is some improvement in medium-term outlook. The breach of the upper end of the target range, while still protracted, is now slightly shorter, with inflation expected to fall within the range during the third quarter of 2017. Inflation is now expected to average 6.7% in 2016, compared with 6.6% previously. In 2017 and 18, inflation is expected to average 6.2% and 5.4%, marginally down from the previous forecast. The expected peak at 7.3% in the fourth quarter of 2016 is unchanged. The downward revisions are due in part to the higher interest rate assumption, a slightly less depreciated exchange rate assumption, a wider output gap, and lower electricity price assumption. These pressures are counteracted to some extent by a higher near-term food price forecast and the impact of upward revisions to the international oil price assumption. The forecast for core inflation is slightly improved, with a lower forecast for 2016 of 5.9% from 6.2% previously. Forecasts for 2017 and 18 are unchanged at 5.7% and 5.2%. Core inflation is expected to breach the upper end of the target range in the third quarter of 2016 for 4 consecutive quarters, with a peak of 6.2% in the third and fourth quarter of 2016 and the first quarter of 2017. The BER survey of inflation expectations is only due for release in July. The median expectations of economic analysts, as reflected in the Reuters Econometer survey conducted in May, are more or less unchanged compared with the previous survey, and are slightly higher than those of the bank for 2016 and 2017. In the latest survey, the median expectations for 2016 and 17 were 6.7% and 6.4%, with inflation expected to be within the target range in 2018 at an average of 5.7%. Bond market expectations, implicit in the break-even inflation rate, are more or less unchanged since the previous meeting and remain at fairly elevated levels. Global growth remains hesitant following a disappointing first quarter in the US and the UK in particular. Whilst labor market conditions in the US have improved, low corporate profits have constrained investment. However, consensus forecasts show that a moderate improvement is expected in the coming months, but at a slower rate than previously expected. The outlook for the UK is clouded by the possibility of an exit from the EU, while the prospects for the Japanese economy remain uncertain. By contrast, the growth outlook in the euro area is more promising, driven by improvements in Germany and France in particular, although there are concerns that the recent momentum may be fading. Divergent prospects are evident in the emerging markets. Russia and Brazil remain in recession, but there are signs of some stabilization in China as the economy appears to be responding to government policy initiative. This improvement, along with a weaker US dollar, has resulted in some recovery in commodity prices, as well as a pickup in portfolio flows to emerging markets. Of some concern is the persistent deterioration in growth forecasts for sub-Saharan Africa, which includes some of South Africa's important trading partners. The region is now expected to underperform the global economy in 2016 for the first time in 16 years, as the effects of lower commodity prices and drought take their toll. Global inflation pressures remain benign, with low energy prices still having an impact, although this effect is likely to dissipate with the current upward trend in oil prices. The latest data show declining prices in the euro area and Japan, and low inflation in the US and the UK. Inflation has remained relatively higher in a number of Latin American economies, particularly those experiencing currency depreciation. As a result of these trends, asynchronous monetary policies persist. While policies are generally accommodative amid subdued growth, particularly in many advanced economies, a number of emerging markets have maintained a tightening bias in response to inflation pressures. The US Fed is expected to continue with its slow pace of policy rate normalization, but there is a high degree of uncertainty regarding the timing of the next increase. The rand exchange rate has remained volatile, and following a few weeks of relative strength, has resumed a weakening path and continues to pose an upside risk to the inflation outlook. Since the previous meeting of the MPC, the rand has traded in a range between 14 rands 20 and 15 rands 90 against the US dollar, and has depreciated by 1.5% against the dollar, by 0.9% against the euro, and by 1.2% on a trade-weighted basis. During this period, the rand was initially favorably impacted by improved commodity prices, the narrower trade balance, and expectations of a slower pace of US Fed monetary policy tightening. However, these gains were reversed as global growth concerns resurfaced in early May, and other domestic factors, including the low growth outlook, concerns about a possible ratings downgrade, and more recently, heightened political uncertainty impacted adversely on the currency. Although the capital flow environment for emerging markets has improved recently, this has not applied to equity flows. South Africa's experience has mirrored this, but with stronger equity outflows. According to the JSE, since the beginning of the year, net sales of domestic equities by non-residents have amounted to 56 billion rand. By contrast, non-residents have been net purchasers of domestic government bonds, year to date amounting to 23 billion rand, although the past 2 weeks has seen net sales. The domestic economic growth outlook remains weak, with the bank's GDP growth forecast for 2016 revised down from 0.8% to 0.6%. While a recovery is still expected in the next 2 years, the forecasts for both these years have been revised down by 0.1 percentage point to 1.3% and 1.7%. With the estimates of potential output unchanged, the output gap is expected to widen over the forecast period. The bank's leading indicator of economic activity continued its downward trajectory in February, consistent with the constrained outlook. Recent high-frequency data paint a particularly bleak picture of the first quarter of this year, following a sharp contraction in mining output, minimal growth in the manufacturing sector, and declines in electricity production and consumption. While the bank's forecast for GDP growth in the quarter is barely positive, it does represent the low point of the forecast, and a slow upward trend is expected going forward. This view is consistent with the favorable developments in the Barclays PMI, which has recovered fairly strongly to above the neutral 50 level for the past 2 months. The real value of building plans passed, particularly non-residential, increased markedly on a 3-month to 3-month basis, indicative perhaps of some life in the construction sector, despite very low levels of business confidence in the sector. However, while the recent modest recovery in commodity prices may impact positively on mining output, prices remain low and the sector remains beset by high input costs and regulatory uncertainty. The continuing drought is also expected to put further strain on the agricultural sector. The economic slowdown is also reflected in labor market trends, with the unemployment rate rising to 26.7% in the first quarter of 2016 from 26.4% a year earlier. Although employment growth was positive over the year to the first quarter, The year-on-year growth rate moderated significantly, with employment losses recorded in a number of sectors, including manufacturing, agriculture, and transport. Household consumption expenditure also remains subdued, with low growth in retail sales in the first quarter. While there was a welcome increase in exports, new vehicle sales also continue to decline. The FNB BER Consumer Confidence Index recovered to some extent in the first quarter of the year, although it still remains at depressed levels and indicates a low willingness to spend and utilize credit among consumers. The constrained outlook for household consumption expenditure is indicative of the absence of demand pressures in the economy. This is also confirmed in the weak wealth effects and the continued slow pace of credit extension to households. Although some improvement has been seen in this regard, growth remains positive in real terms and is mainly related to mortgage advances and general loans, particularly unsecured lending. Growth in credit extension to corporates remains strong, but moderated in March. Wage growth appears to be moderating, with growth in nominal remuneration per worker in the formal non-agricultural sector declining to below 6% in the fourth quarter of 2015, mainly due to lower private sector remuneration growth. Once adjusting for labor productivity, growth in unit labor costs remained unchanged at 5% in that quarter. Food prices remain a significant risk to the inflation outlook in the face of persistent drought and exchange rate weakness. These pressures are evident in both consumer price and producer price indices. Although for some time the MPC has been expecting an acceleration in food price inflation, the recent increases have surprised on the upside, and more aggressive food price increases are now forecast for the near term. The bank now expects food price inflation to peak at around 12% in the final quarter of this year. However, should food prices stabilize or decline later in the year, there is the potential for downside base effects next year. Futures prices suggest that both maize and wheat prices are expected to remain elevated for the rest of the year, reinforced by a sizable increase in domestic wheat import tariffs. The international oil price assumptions in the forecasting model have been increased, with the Brent crude oil remaining firmly above the $40 per barrel level since the second week of April. Demand has surprised on the upside, and despite an increase in supply from Iran, output has declined in a number of countries. This upward price trend may, however, be contained by high levels of inventories. Domestic petrol prices have increased by a cumulative 1 rand per litre since March, mainly due to higher international prices and an increase in the fuel levy. Should current exchange rate and international oil price trends persist, a further significant increase can be expected in June. The MPC faced the continuing dilemma of upside risks to the inflation forecast and a worsening growth outlook. The risks to the outlook are assessed to be on the downside, particularly in the short term, despite the downward revision to the forecast. Both mining and agricultural sectors are expected to weigh heavily on the first quarter growth outcome, and the outlook is therefore dependent in part on whether these sectors rebound in the coming quarters. The MPC remains concerned about the inflation outlook and the extended breach of the target. Although the inflation forecast has shown a moderate improvement over the medium term, the risks are still assessed to be on the upside. The exchange rate remains highly sensitive to domestic political developments, and risks of an earlier than expected tightening in US monetary policy. The exchange rate implicit in the forecast is stronger than the current level, imparting a significant degree of upside risk. While pass-through from the exchange rate to inflation remains relatively subdued, there are indications that this may be increasing. There is also some upside risk to the international oil price assumption. The committee remains concerned that inflation expectations remain at uncomfortably high levels. Although core inflation has remained relatively contained in recent months, with a lower peak now expected, it is forecast to accelerate and exceed the upper end of the inflation target range for 4 quarters in response to exchange rate and wage pressures. Some countervailing risks are also evident. While there is a risk that food prices may accelerate faster in the near term, the longer-term forecast assumes that food prices will stabilize by year-end, allowing for favorable base effects next year. However, should food prices, particularly grains, decline in response to a normalization of weather patterns, a much sharper downward food inflation trajectory could transpire. The absence of demand pressures and risks to consumption expenditure growth may also contribute to downside risks. The increase in the repo rate at the previous MPC meeting contributed to the improvement in the longer-term inflation forecast, and that move should be seen in conjunction with previous actions in the cycle and the lagged effects of monetary policy. The MPC felt that there is some room to pause in this tightening cycle, and accordingly decided to keep the repurchase rate unchanged for now at 7% per annum. 5 members preferred no change, while 1 member preferred a 25 basis point increase. The MPC remains focused on its inflation mandate, but sensitive to the extent possible to the state of the economy. The MPC will not hesitate to act appropriately should the inflation dynamics require a response within a flexible inflation targeting framework. Future moves, as before, will continue to be highly data dependent. At this stage, let me invite you to pose your questions. And as usual, please identify yourself and the media house that you represent. Sir, in the front here, you look very new. There is a thing that looks like you can speak on the microphone there. Yeah.
Ah, there we go. Thank you very much, Governor. My name is Olim Gambi. I come from ENCA. And I'll ask you a question slightly unrelated, but nonetheless, I will try. Have you received, Governor, an explanation from the 4 major banks in the country around their decision to terminate the banking services to Oak Bay Investments? And are you satisfied with that explanation that they have given to you? Is there anything perhaps irregular about what Oak Bay has done, in your view? And finally, therefore, if this decision becomes final, what happens to companies who do business with Oak Bay Investments, in particular, state-owned entities like Eskom? Thank you.
Okay, this is a question that has been coming for some time, but it was not the subject of the discussion at the MPC. So if you don't mind, if we deal with the business of the MPC, I will deal with it at the end.
Thank you, sir.
Tsepo.
Good afternoon, Governor and members of the MPC. You've mentioned that the core inflation could increase mainly because of wage pressure. I mean, we've heard of workers from Eskom demanding an 18% increase. Does that mean that you foresee, pressure coming from higher wage settlements and putting pressure on inflation going forward?
Ntsakisi.
Thank you. Good afternoon, Governor. Ntsakisi Mashangani from Business Day. The MPC has constantly been revising the GDP forecasts for some time now. Is this not maybe an indication that a longer pause in rate hikes could be warranted? And the second question is around the politics, which you mentioned, saying that these have also tended to move the rand lately. Is the bank concerned that politics are becoming a burden on an extra burden on the rand, seeing as already we have several factors like the weak dollar already playing a role there? Thank you.
Shall we take one last one in this round? Ma'am?
I'm Khalang Bata from Bloomberg News. Governor, you said in your speech that the exchange rate implicit in the forecast is stronger than the current level. And we've seen the rand volatility increasing quite a lot, and we've seen those sharp drops, especially related to political uncertainty coming from certain departments in government. We saw how the rand was impacted when the former finance minister Nhlanhla Nene was fired, and as well to some reports over the weekend about the current finance minister. My questions are, why have you still stuck to a stronger level in the rand in terms of your forecast than the current level, given these sporadic sharp falls that we've seen in the rand? And yeah, I think I'll leave it there.
Tsepo, yes, our preferred measure of underlying inflation is core inflation, and that is headline inflation excluding food, electricity, and petrol prices. And we exclude those three because those three are generally volatile, to try and understand if there are other prices that are also moving. And that is what we should actually be looking at and say, is there a generalized increase in prices? So you'd identified the link with the wages, which is a very important feeder into the price formation process. On their own, high wage increases are not a problem. But if they outstrip productivity growth, then they become a problem. But in an environment where you are also having inflation, although outside of our target, it's still in single digits, increases that are way in excess of that would not make the respective companies particularly competitive. But those will be the subject of collective bargaining arrangements, outcomes. Are we concerned? Of course, we are concerned because core inflation, as we say in the statement, is expected to be outside of the target range for 4 consecutive quarters. And if the monetary authorities do not take a decisive stance, then it ends up with a situation where you have got these things feeding on themselves and spiraling, and very soon inflation expectations could become de-anchored. It is that focus that had guided us over the past few MPCs that we decided that we must act. And in that, all of those steps that we had taken, we were cognizant of the fact that the economy is actually still weak. Hence, fairly measured steps to deal with the inflation without trying to choke the economy. Yet, we're still of the view that the current stance is still accommodative. Ntakisi, you raised the thing. Yes, we have been revising our growth forecasts lower, but we are not the only ones. Everyone has been revising their forecasts lower. Such is the nature of the uncertainty that we are operating within. Does this mean that this could be a longer pause? Well, we take every MPC as it comes. We look at the forecast, we look at the data, we look at what that data is telling us, and on the balance of risks, we will then take an appropriate decision. So in this meeting, we decided to take a pause on the current tightening cycle. So it is a pause, it's not a reversal. Politics, impact of politics on the rand, and of course this does link with what Amogelang had asked. There had been volatility in the exchange rate. We had indicated that the exchange rate volatility does concern us. And if you took the period last year, you would have actually seen that the rand was moving in tandem with other currencies of commodity exporting emerging markets. That de-link took place in December for our own idiosyncratic reasons. Currencies react to a range of things. The one thing that is clear is that uncertainty is not good for the currency market. We have had a number of policy uncertainties experienced here, and we had also seen politics impacting on the markets, and I leave it there. Don't ask me how. Oh, that deals with all the questions. Thank you. Any other questions?
Well, that's where we leave. Reserve Bank Governor Lesetja Kganyago announcing today that interest rates do not change for the moment. The bank pausing in what we're in right now, which is a rate hiking cycle, but choosing not to raise interest rates this time. I can tell you that the rand has already dropped. That's because a rate hike would have essentially made South Africa that much more competitive to global investors. They get higher yields here, and that's important. Our rand also reacts to interest rate decisions, especially in an environment when the US is raising its interest rates, becoming more competitive. We'll break this all down after a short break. I'll be speaking to FNB's chief economist, Sizwe Nqedlana, and Dennis George from Fiducia. We'll be with you shortly.
Vera Ephraim defied family and traditions to follow her dream.
Decided that I'm going to prove to them that they were wrong.
The first breakthrough came in when she was studying and touring in Europe.
That was my first breakthrough.
Generations was her first television debut in South Africa.
It was my first gig. I was very excited. I was very happy. I said, yeah, this is confirmation I'm at the right place.
After pain, rejection, and suffering, her dream became a reality.
I followed my path, and I'm happy and grateful and blessed.
Join your host, Wileng Mulabati, on Wupilong every Friday at 17:30.
Health Talk unpacks healthy tips to help you to practice healthy living lifestyles.
Now, generally, type 1 is found mostly in children and young adults, and with type 2 diabetes is found mainly in the older generation, and also with an issue of obesity.
Don't have second portions, and then I've brought this plate model to show that for both meals, your lunch, your dinner, half a plate should be vegetables.
Within sports, we see the spectrum itself. Most often we see minor head contact injuries, we call them.
Right.
But certainly in sports, the one that a lot of attention is paid to is concussion.
You see, got something.
Significant steps to deal with the concerns that had been raised by the rating agencies. We will explain ourselves, but in the final analysis is the credit committees, sovereign rating committees that makes this, these decisions. What will the impact be on the rand? I don't know why the impact should only be on the rand. I think it should be on other financial variables as well. The impact will depend on how much of the downgrade is already discounted into current financial market prices. And to the extent that it has been discounted in the financial market prices, you shouldn't expect a significant reaction. But if it is not discounted in the current financial market prices, you will expect that there will be a repricing of South African financial assets. Any other question? Yes, Candice.
Okay. Question from the webcast, Governor, from Jared Houston from Macanthan. You forecast economic growth to pick up in 2017 and 2018. What is the justification or catalyst for this?
Okay. Any other? Hillary? Rashad, you're going to answer your growth question.
Governor, since we've got non-monetary policy committee questions, could I add one, which is that of our big banks, there are a couple in play. Mr. Naidu has expressed the bank's sort of reluctance to entertain private equity shareholders of any size in any of our banks. But I wondered if you can comment on any other preferences you might have on bank shareholdings, whether, for example, you prefer controlling shareholders or a spread of shareholding, whether you would want a shareholder reference in big banks, or that is not an issue. If you could give us some sense of what the regulator's preferences might be in such cases.
Okay. Mr. Naidu will deal with that once we are done with the monetary policy questions. Amukela?
Governor, I'm going to go back to my question. You said in the speech that you're expecting that the exchange rate implicit in the forecast to be stronger. My question is, why are you expecting that the exchange rate will be stronger, especially given that the rand has lost about 20% of its value since the beginning of last year? So what are the reasons behind that particular forecast or expectation?
No, well, all that we said was that the assumption that is embedded in the forecast that we are having is stronger than where the rand is today, right? Because the things move every day. The MPC started meeting on Tuesday. We start reading documents over the weekend and so forth. So we arrived at an assumption based on the information that we had at that time. Where the rand is going to be in the future, I can tell you, if there is any forecaster out there who can tell you that they can forecast exchange rates accurately, tell them they are deceiving you, because it is a nightmare to forecast where currencies are going. So based on the best information at our disposal, we arrived at the assumption that we have in the forecast. And come the next MPC, we will again look, where is the rand? What is it likely to be impacted by going forward? And then we will make a fresh call at that stage. Thank you. Okay. Any more monetary policy questions? Okay. In the absence of any, let me turn to this question. Before I did, no, yes. Rashad, I said you must deal with growth. Yes.
Yeah, thank you very much. Let me just first add that our forecast for growth is by no means a celebration. It's really low at 1.7 and 2% for an economy that has an unemployment rate of over 26%. So we're not projecting major growth for the next 2 years. But I think that you know, part of the underlying reasons for these forecasts, as is often the case, there's a number of factors that could underlie this. But the one thing is, we assume that global economic growth would be better than what it is currently, so there'd be some pickup in global economic growth. And we think that maybe commodity prices will stabilize. We think there'll be some stimulus from a depreciated currency. We think that some of the massive infrastructure now will kind of be less of a constraint, so we'll be able to take more advantage, and the economy will be less constraining. So those are more or less the factors, but as I say, it's not a dramatic pickup in growth. A lot of the near term, or the 2016 growth, is also quite dependent on the current existing growth rates, which influence it. Thank you very much.
Whilst we are at it, I've just gathered more information for you. Just to say to you that in working on the inflation and growth outlook, the assumptions you make, you have got two choices. You could say that this is my assumption. There is so much that is changing. Change the assumption. Because it's an assumption, remember, it's not a forecast, it's an assumption. Or you could go with the assumption that you have and highlight the risks with your assumption. And we have taken the latter. We say to you that our exchange rate assumption in the model is stronger than what is currently ruling. And we go further and we say that the risks to the inflation outlook include the depreciation of the currency, that a weaker currency could lead to higher inflation. Dita and Xoli, explanation on the banks and Oak Bay and what this thing means. Let me first start by stating the obvious. The Reserve Bank does not interfere in the relationship between a bank and its clients. We have got a responsibility to prudentially regulate the banks. And we derive that power from the Banks Act. The Financial Intelligence Center Act also gives us particular responsibilities with respect to the banks. And those responsibilities entail us having to assess whether the banks have got adequate procedures to comply with anti-money laundering and combating the financing of terrorism activities. Those are done in terms of the Financial Intelligence Center Act and its regulations. If the banks pick any suspicious transaction in terms of the Act and the regulations, that suspicious transaction report gets sent to the Financial Intelligence Center. The regulations further state that if a bank has reported a suspicious transaction to the Financial Intelligence Center, it shall not disclose such a report to anyone. So, what suspicious transactions the banks have picked, we don't know, because according to the law, they should tell the Financial Intelligence Center, not us. So, the thing comes and you say that if there are any irregularity, have the bank reported anything to us, then it goes without saying that the banks wouldn't report anything to us. But then you are going to say to me, but you are the central bank and you oversee these banks and they are closing the accounts of a client, do something. Well, there is nothing I can do other than to suggest to the client who feels deprived to approach the courts and enforce their rights. That is the only route that is open. That's all that I could say with respect to what we could be doing. What does that mean for the clients of the entity that you have talked about? Well, we don't regulate that entity, neither do we regulate their clients. So we don't know what would happen to them. So I hope that clarifies it. Let me turn to Mr. Naidu to talk about the actions in the banking space.
Thank you, Governor. Thank you, Hilary, for that question. Let me start off by saying that we do not comment on any specific transaction or any specific meeting or any specific bank or proposal from a bank. Right? It is not fair for us to make those comments in public. And so my comments at the Financial Stability Review launch were in general. And I'll repeat those comments. That in general, the South African Reserve Bank would prefer not to have private equity or highly leveraged structures in bank ownership. And the reason why we would prefer not to have that is because it introduces a degree of instability into the bank and in the banking sector. Right? How you define private equity or how you define leverage structures, I'll leave it open to you. But in general, we prefer long-term investors, we prefer stable investors, we prefer investors who have a commitment to the country and investors who have deep pockets. So those are the preferences for which we seek. But we are not going to comment on anything specific beyond that at this stage. Thanks.
Dieter, your thing, you said you also raised an issue about what are the issues for financial stability. There are no financial stability implications in this. Okay? Toli, you are still on this one. I thought that I had said everything I wanted to say.
Indeed, Governor. Well, just for the record, are you in a position to name these banks that have embarked on this particular decision?
I wish I knew them. I wish I knew them. I told you, they can't tell me. The banks don't discuss their relationship with their clients with me. So now if these banks had come to tell me we have closed that account and we have closed that account, we have closed that account, it would have been an interesting one for me to deal with, because then I might count and said so many banks came to speak to me about these things. But even if I had a discussion with a particular bank on anything, I wouldn't tell you. As Kuben Naidu said, we do not discuss individual engagements with particular institutions. Thank you very much. That concludes the press conference of today.